From the CUBE studios in Palo Alto and Boston, bringing you data-driven insights from the CUBE and ETR. This is Breaking Analysis with Dave Vellante.
While the NASDAQ seems to be reaching new highs daily, today included, tech spending remains persistently cautious at the macro amid continued uncertainty. Now, that's not necessarily bad news, but it can be disconcerting to decision makers. Often during transitional cycles like the one we're in now, executives, they don't want to over-rotate on capital allocations that deliver outcomes which could potentially be achieved much more cost effectively with emerging technologies like AI. We've seen similar patterns in previous waves. There was a period of great softness in enterprise IT spending when transitioning from mainframes and minis into the PC era. There was a huge backlash from overly exuberant Y2K and .com spending and a steady deterioration of traditional enterprise tech momentum during the cloud, mobile, SaaS, social, big data era. Now, each wave is different, but two common themes remain. One, strong conviction that a new era is here, i.e. believers. And two, fear of disruption, which sometimes leads to hasty decision-making and sometimes waste. These countervailing forces seem to be in play today, as the data suggests that 87% of enterprises report taking a cautious approach to AI investments, not a wait and see, but prudence. And that caution is showing up in the macro spend environment. Hello and welcome to this week's theCUBE Research Insights powered by ETR. In this breaking analysis, we take a look at the quarterly spending data from ETR and give you our take on what's happening in the market at the macro level and how the spending climate has changed over the last several quarters. We'll quantify the stubborn weight of uncertainty, both technological and policy driven, and convey how enterprises are responding. So let's start by taking a look at tech spending sentiment going back to the boom times in 2021. This data from ETR shows the quarterly expectations of annual IT spending growth from around 1,800 IT decision makers, ITDMs. As we've discussed in the past, we're well off the halcyon high single-digit spending growth environment from the isolation economy, i.e. COVID. Now, calling your attention to 2025 here on the right-hand side, we entered the year with ITDMs expecting a healthy 5.3% increase in annual spending. That declined to 3.4% in the spring survey and is slightly upticked in the July 2025 survey to 3.6%, but still well off the January highs. Now, of greater concern is that you can see the large spenders, which is reflected by the Global 2000 data, they expect a 2.9% increase, significantly lower than the average, with SMBs more optimistic at 4.5%. The reason for the concern is that small and mid-sized firms, they are somewhat more susceptible to things like tariffs, and their ability to shield the hit is lower than the large global firms with much better cash flow. So it's interesting when you look at this data to plot the change in tech spending against the two-year treasury, as we're showing here. The blue line is the price of the two-year, which is basically inversely proportional to the tech spend sentiment. In 2022, we still had the exuberance hangover from COVID and the COVID spending spree, and as interest rates spiked, tech spending expectations, they slowly waned from roughly 7%, a little over 7%, to 6%. But as reality set in, you can see the July 2023 spending trajectory tanked. So organizations responded very quickly. It dropped to under 3%, just 2.9, and has remained in the mid threes since. Now, in addition to the factors that we mentioned up top at the beginning, cyber risks have escalated along with all the geopolitical gymnastics and of course AI, leading to this persistent caution that we've cited. And an interesting data point from a previous ETR macro survey is shown here, which gauges the degree to which geopolitical and other concerns have affected organizations' posture toward operational resilience. You can see the question, how much of a priority is strengthening operational resilience for your organization in light of the specific challenges around geopolitical tensions and other disruptions. And you can look at this data as, okay, a large percentage of customers are making resilience a high priority. Are the ones on the right more exposed, or maybe they're more resilient already? We don't know from this data other than it conveys that resilience has become as we know, a top concern. And we've known this for quite some time. And so the main reason for this, or a main reason, with all the changes that organizations are facing, geopolitical, the pace of AI, the ability of attackers to use AI effectively. So cyber risks are being cited by ITDMs as their number one concern and their biggest exposure, perhaps the most difficult also to address because of the changing nature of cyber and the threat vectors. So the urgency is shown here in this graphic from a recent study conducted by theCUBE Research, which was led by our analyst, Christophe Bertrand, which quantifies the time it takes to recover from a cyber attack. So the leftmost data, the stacks on the left, asks 600 organizations to estimate how long it would take to recover from an attack. And the rightmost chart asks those who actually experienced a cyber attack, what their experience was. And the right, those who have experienced an attack, only 2% could recover in a matter of hours, and only 12% less than a day. So the majority on both data sets face multiple days to recover. And you can see the APAC and Europe and with the different data points there. Christophe also cut the deltas between traditional IT and the cyber security group. Anyway, his research quantified the cost of such disruptions. We're not showing that here, but there are a lot of studies that do so as well. But the key points are: one, the productivity hit of an attack is many days or weeks of lost productivity. And two, organizations are beginning to understand the realities and are generally realistic about their capabilities. The other key point is budgets aren't unlimited, even for cybersecurity. And we've talked about this before. In addition to keeping the lights on and running the business, organizations, they have to grow and transform the business. So they got to fund new line of business initiatives, they have to fund AI, and they have to keep iterating on cyber. So all of these factors weigh into the macro spending data that we shared earlier, and in many respects accounts for a lot of the uncertainty. So for those organizations feeling the budget pressures and decreasing spend, how are they doing that? Let's take a look. On balance, 20%, only 20% of organizations in the study are reducing their IT spending, and that's down actually from 2 years ago. So that's a positive. And they're doing it by cutting staff, as you see in the leftmost set of bars. And that approach is back to the highs from last October survey. And you can see new projects getting delayed. While it's the second most common technique, it's in decline in popularity. And further to the right, you can see reducing cloud expenses is picking up steam. So let's dig into this a little bit more deeply and look at how organizations are approaching increasing their IT spending, which is what we're showing here. So you can see new projects are being accelerated, and that's the top technique, if you will. And you can see that expansion of cloud resources, while still number 2, is in decline. Okay, so based on this and the previous data, you may surmise that the cloud is coming under pressure, and that could be a negative and a concern. Well, let's take a look at that and double click on it. This data here shows spending by category, and the categories that ETR tracked in this question are cloud, hardware spend, outsourced services, and software, both on-prem and SaaS. And you can see, while the previous data could be interpreted as a negative, the cloud still far outpaces the other broad areas that are shown. It's got 8.1% annual growth. By the way, that's more than double the macro average, which is in the mid-3s, and far above hardware, outsourcing, and SaaS, which are 1.4%, 1.6%, and 3.5%, respectively, all in the low or kind of low to mid single digits. So remember, cloud growth for just the big 3 hyperscalers that throw in Alibaba is going to surpass $250 billion this year. And that revenue is going to grow in the mid 20% for the group. So still very strong and outpacing most other sectors. Notwithstanding AI is growing faster than all of them. But cloud is being propelled by AI, a strong base of existing workloads that continue to grow and expand, and this flywheel of ecosystem vendors, the like of which doesn't exist elsewhere, including on-prem, at least not at this point. What we want to do is close with a view on what the outcomes are that organizations are seeing from their AI spend. Now, so you hear the vendor narrative at the conferences that we go to is that we've exited the experimentation phase. We're out of AI POC purgatory, and we're entering the deployment at scale phase. So we don't quite see it that way. Most customers continue to tell us that their AI is nascent and largely experimental with uncertain ROI. Many customers are bringing their AI on-prem. They're experimenting with that. A lot of the large banks, as we've talked about, are building their own on-prem AI stacks, citing that the cloud is too expensive, and they don't want to move certain workloads into the cloud. So, there's some shifting going on there. I wouldn't say it's repatriation. I think it's just a shifting of priorities and a building up of internal capabilities, especially around their proprietary data. So this, in many ways, is good news in that the potential for increased value is enormous. If right now the value return isn't huge, that's maybe okay, because if you, as we believe, that the AI era is a durable trend, that says that there's some significant upside. So the data here shows that AI is, first of all, being used to enhance productivity and augment mundane human tasks, human in the loop. And second, supporting better analytics is kind of a no-brainer, because we all say, and it's true, when you have good data, you can get better AI and you can get outcomes faster. So you have good analytic data, for example, in Snowflake or Databricks or in a cloud warehouse or lakehouse. Bringing AI into that mix makes a lot of sense. It's low risk and it's low hanging fruit. Now notice the third bar here, i.e. transformation with new revenue streams. We see that as taking more time, but the net present values of that, the size of the value, is going to be much greater. So, remember, ROI is the percent return. The break-even period is the time it takes to get return. Those are all nice, and CFOs want to see short timeframes, but the real money is with net present value. Would you rather have $100 million of net present value in a year and a half, or would you rather have 1,000% ROI on $100,000 in 12 months? Well, you'd clearly rather have the former, at least I would, versus the latter. So anyway, these larger projects are going to take more time, these ones that are going to drive revenue, and there's still a lot of early experiments going on. Now, the drop off to number 4 is notable, i.e. headcount avoidance or reductions, but it is real, it is tangible. Andy Jassy has talked about it in his letter to shareholders, and many others are speaking directly to the fact that AI is going to affect jobs, and jobs are going to shift. And that could have a negative effect on employment in the near term. But longer term, we agree. We believe that it's going to create opportunity. And surprisingly, or maybe not, 10% are still really not going after AI in these stated areas. Our interpretation of this data is that they're waiting. So let me come back to the point on productivity. As we've shared in previous breaking analysis segments, there have really only been 2 sustained, nearly decade-long productivity booms since World War II. One is coming out of the post-war era with a big increase in manufacturing in the United States in particular, and a huge consumer buyer flywheel. So you had manufacturing sites growing, you had the consumption increasing, more manufacturing coming in, more jobs, better manufacturing techniques to drive more product that got bought more. And so the 50s and into the 60s was a big sustained period of productivity. The second, of course, was the PC productivity boom in the 1990s. Many economists would joke that in the 80s, PC or productivity was everywhere except in the numbers. And so they could, the point being, they could feel it coming with the PC boom. And certainly that's what happened, well into the 90s. So many, us included, believe that we are on the cusp of another sustained period of productivity growth. So let's think about that for a moment. VC investments in AI were around, let's say, roughly 50 billion in 2024, and expected to double this year and continue to grow. The big 3 hyperscalers plus Meta, they're going to spend north of $300 billion this year on CapEx. So let's round up. Let's round, way up. Let's say $500 billion is being spent on AI with, as we said, marginal returns at the moment. Sounds like a lot, right? $500 billion for a marginal return. Why do that? That seems like it's a little over exuberant, but let's step back. If you think about the global economy, it's north of 100 trillion. And people are talking about 10, 20, 30% improvements in productivity. Now, those aren't trivial. I mean, 10% alone would be a massive positive to the economy. That's $10 trillion. And again, I'm being conservative, I'm rounding. 100 trillion is probably more like 115, $120 trillion global economy, but that's a $10 trillion annual increase in productivity. So taken in that context, 500 billion, maybe isn't that outrageous and perhaps is even conservative. It's a 20x return, and that's annual. So the question for you is, should you dive in now or wait? There are a lot of examples in business where fast followers have thrived in these new waves. Facebook wasn't the first social media company. Dell wasn't the first PC maker. Google wasn't the first search engine, on and on. There are many, many examples in tech and other industries as well. So over rotating on capital allocation, earning in a cycle can be dangerous, sometimes futile, or even put you out of business. So at the same time, not participating is almost certainly going to leave you behind, and that could also put you out of business. So our advice is start by picking the right spots in your business. You gotta align with where there's business value. So where is the business value? Where are the AI and automation opportunities? And then second, if you have a choice between high value and easy wins, what do? Well, you pick the easy wins first, as long as there's some business value there. It doesn't have to be the high NPVs that we were talking about earlier, because that will take longer to achieve. The reason you want to do these easy wins is because you want to get the culture behind this, because the people in the organization are concerned about their jobs. They're concerned about change. Change is discomforting, and they might be losing their jobs to machines. So you've got to get the culture behind the idea that a new wave is coming, and they got to ride that wave, or they're going to end up as driftwood, as we like to say in theCUBE. And then you want to use that mindset to build muscle memory, and then let the distributed and decentralized organization build value throughout the system organically. They will know where to deploy the agents. Your job as an executive is to provide the North Star vision and a foundation of a solid data strategy and the tooling and resources so they can make it happen. We are very excited about the future at theCUBE Research and theCUBE and SiliconANGLE, as I'm sure you are too. The macro uncertainties, they're always going to be there. Even when things are booming and they seem great, there are blind spots around every corner. So hopefully our data and your knowledge of the market can help you navigate the unknown. We're looking forward to being on the journey with you. Thanks for listening. Okay, that's it for now. Thanks to Alex Meyerson and Ken Schiffman, who are on production and run our podcast, and Kristen Martin and Cheryl Knight help get the word out on social media and in our newsletters, and Rob Hof is our EIC over at siliconangle.com. Thank you all. Remember, all these episodes are available as podcasts wherever you listen. Just search Breaking Analysis Podcast. I publish each week, almost each week, on thecuberesearch.com and siliconangle.com, and you can email me at david.vellante@siliconangle.com or DM me at dvellante. If you want to get in touch, comment on our LinkedIn post, and please check out ETR.ai. As you can see, they've got great data on enterprise tech spending, tons of stuff that we don't dig into here, and a lot of proprietary data that you want to have access to. Best survey data in the enterprise tech business, in my opinion. This is Dave Vellante for theCUBE Research Insights, powered by ETR. Thanks for watching, and we'll see you next time on Breaking Analysis.